Awesome. So today we're here to talk about a topic that I'm sure is on many of the minds of the founders here in the room today, which is fundraising in a post-pandemic recession. I thought that was kind of a bold name for a panel by Adam when he told me about this, because we're not like quite at a recession, right? So pretty bold. But unfortunately, it looks like, especially after this week, we're probably on our way there, especially in the UK, unfortunately. We've got some amazing people, really experienced people here to talk about this topic with us tonight, and we really wanted to get into the nitty-gritty, into the conversations that people are having with founders. What are investors telling founders? What should founders be talking about? We've got two amazing early-stage investors. We've got Maria, and we've got Emma, and we also have Maria's mom in the room. Can we give a round of applause to Maria's mom? Incredible, with her 8-week-old baby too, who is definitely interested in fundraising, I would assume. Then we also have Anil, who's been in the tech biz, he tells me today, for a very, very long time. So has seen ups and downs, two crises. This is your second crisis, as the CEO of Market Finance. Then we've also got Adam, who had ample time to introduce himself now, so I'm sure you all should know who he is. And then we've also got Johnny, who's VP of Capital Markets at Crowdcube, the crowdfunding platform, who's got an incredible overview of tons and tons of startups in the market and how things are playing out. So maybe we could start off with you, Johnny. Tell us a little bit about what you're seeing, what's changed, and what do founders want right now?
Yeah, great. Cool. Yeah, so it's a super interesting time right now. Obviously, fundraising is really, really challenging, and we're very, very aware of that. We are on the beating heart of the fundraising landscape at Crowdcube. We've currently got 27 companies actively fundraising on Crowdcube, anywhere between 7 days and 30 days. We've got 15,000 unique retail investments live on platform, invested over 12 million, which probably tells you that the appetite from retail is still there. I think one thing that we're seeing is check size is on average down year on year, but investment volume is still there. And for retail investment, we'll come on to the institutional side, the schemes around EIS, SEIS are still very attractive. And for the right companies at the right valuation, certainly fundraisers are still happening. So what are we seeing on the founder side? Typically, valuations are the biggest pain point. So we're seeing a lot of return raises that are either down on previous valuation, so that might be our funded portfolio that are coming back to us, and or companies from the wider ecosystem who are quite simply fundraising at a lower valuation from previous institutional rounds. We're seeing a lot of convertible rounds, simply I can't price it. And we're seeing a lot of flat rounds, frankly. And these guys will be able to talk a lot better with a lot more detailed insight from their portfolio. We are far more bird's eye view. But the realities are that it's tough. But for us, we're certainly seeing investment volumes are there, but the value is slightly down on the retail side.
Makes a lot of sense. So yeah, maybe we can come to the institutional side of things right now. Would love to know, maybe we can start with you, Emma. What are the conversations that you're having with founders, and give me some concrete examples of kind of how things have changed?
Is this working? No?
This one is.
There you go.
This one. It's working. It's green. It's green.
Hello?
Yeah.
Oh.
Yeah.
Do you know what? What's interesting is that the market was so mad last year that most people have raised money to get them through the next year at least. So I don't think the depth of the tough conversations that have happened yet. Like, a lot of people were very proactive in their response to the changing market. They use it as a chance to what we call chopping fat and getting rid of the teammates that they probably wanted to, but never had like the reason to. There are some find that funny? Sorry, we've had a few incidents in the front. There's like red wine spill. There's people giggling. It's a bit distracting,
Chaotic.
but we pull it back. But look, there are some companies obviously that are struggling, like everyone else. Like we were traditionally like pre-seed and seed stage investors. We now have a growth fund, and we now have a sort of private to public market fund as well. I think the biggest struggles we're seeing at the moment are the slightly later stage ones, like the Series B, Series C. Like, they are taking substantial amounts of times to get done, like really substantial, like amazing businesses that you think should get over the line very quickly are just taking at least 6 months to get done, which is something I've been working at Local Globe for now 7.5 years. I've never seen it like this. But the early stage, look, and Twitter is doom and gloom, but great businesses are still getting funded. I think there is a bit of a nervousness for first-time founders that haven't yet sold their product. Like the MVP stage is slightly tougher, but for good founders with good businesses, like we're still writing checks and it's still getting done.
You mentioned in our like briefing call before that you were seeing some interesting terms and that stuff kind of changed. Could you give some examples of that?
Yeah. Sorry, I forgot about that. So what we've seen a couple of times, and do you know what? Non-traditional VC investors may have done this traditionally anyway, but like from the types of funds that we work with for Series A, Series B, Series C funds, one thing we have seen that's changed is people wanting to invest capital that lasts companies at least 3, if not 4 years. And they are putting some interesting clauses into their long docs surrounding that. So things like a 2.5x liquidation preference should the company not raise their next funding round at least X valuation, because they're writing a check that should last this company for 3 or 4 years. Traditionally, we would have been like, do not take their money. But now we're like, that's kind of interesting. Maybe we should look into this. And we've had one term sheet signed on quite similar terms to that, because the company wanted to raise about 4 million as like a seed extension. They got offered, I think it ended up being about 12 million round. And it was like, we will give you this if we have a 2.5x liquidation preference, but it only lasts X amount of time should you not raise a follow-on round at X valuation. And they took it, and they were quite happy with it because they believe they'll be able to do it. And as seed investors, we will get completely wiped out as well if the company doesn't do well. But even we were encouraging of it because we're super bullish on companies raising money for at least 3 years at the minute. And interesting times.
Wow. Oh my gosh.
Yeah, a lot of the same things we're seeing. I'm at Kindred, so we do pre-seed and seed, very early stage. And like what you said, Emma, we're still writing checks. So I just did 3 deals this past year. We're a high conviction fund, so we don't do a ton of volume in a row, but we are actively still writing checks. I think that people have been raising in up markets for a long time. And so there was a lot of feeling last year of why would I raise 2 on 10 when I could raise 4 on 20? And the answer is usually the next round. And I think that people haven't really lived through a down round. And I saw actually a lot of bad behavior. I was at a fund in the US during COVID, and I watched a founder get like almost essentially wiped out his own dilution just to keep the company alive. And I watched a lot of bad behavior from that VC cap table specifically, and you really wish it wasn't there. You know, we talk a lot about like value add VCs, and both Emma and I actually started on the platform side. And I think that really good VCs actually do bring value, and they can be helpful on the operational side. They can be helpful just emotionally, honestly, just to be a support in the crazy journey that it is to be a founder. They can be helpful in a lot of ways, but I think that we forget that there's also a lot of value destructive VCs. So actually your main job is just to avoid a value destructive VC and get a value neutral to value positive VC. But I think truthfully, you're going to see a lot more of that bad behavior in an environment like this, because people couldn't do it last year. It was too competitive. It also depends on the space a lot. I do a lot of crypto Web3 as well, and we're on like the 5th or 6th cycle of that in the last few years. And so those valuations were arbitrarily higher, but they've come down a bit recently too. So it kind of depends on your space, but we are seeing a lot of the same stuff. The later stage companies are definitely getting hit, and valuations are just in a different spot.
And just to go a little bit deeper on that, you know, when a founder, other than like looking at the term sheet and looking at the terms that are presented, how can a founder kind of suss out whether that VC really has their best intentions in mind?
Yeah, just cold reference every VC, straight up. Like at the end of the day, don't get me wrong, we're fundraising a fund right now too, and money's green everywhere, right? And now it's in parity with a lot of other countries as well. But it's really green everywhere, and so you have to take what you can to survive. And actually, in the case of the founder who I watched get screwed in the pandemic, he went on to have an almost unicorn company now and has done great even regardless, and he's gotten topped up. So it's worked out well, but that doesn't always happen, and companies do go under. I think that on the specifics, you just have to cold reference. VCs will give you, I will give you, if I'm giving you a term sheet, references, but you should contact anyone you want. And you should, especially in someone like me who moved to the UK and switched funds, you should definitely go talk to the founders I worked with in my last fund, who I'm not on their board anymore. I'm not on their cap table. And you would be shocked. I think like cold VC emails, I wouldn't really recommend. They don't really go over that well, which is a bit of a shame for diversity and inclusion, but that's a different conversation. But I would definitely recommend cold founder reach outs. Like, if you've had a bad experience as a founder, you will absolutely respond to someone on LinkedIn or email to like try to avoid them going through the absolute hell that you went through. And we try to do it for founders too. Like there was a term sheet recently where our company, it was a co-investment round, and we had heard mixed things about the investor. So we went and did our own cold references and came back and also told them kind of what we had heard that had happened to founders as well. And I think all of this structure, as it's called, these additional things that come in the term sheet, whether it's look pref or something else, they usually tend to be more about control and more about downside protection. But quite frankly, and I see a lot more of that bad behavior in Europe than I do in the US, if you have a term sheet that to you says they're really trying to protect the downside, it's probably someone who doesn't really get VC, because VC is really all about upside. And so that's the first flag, I'd say.
Yeah, I mean, it is a community of relationships and that stuff. Definitely people will talk about it, even to journalists. I think the other side of the story around funding right now is that founders are also looking for not just VC, but other places that they can tap for capital. Neil, you want to talk a little bit about how that's working out for you, and maybe some of the conversations that you're having with founders who are looking at those different options?
Yeah, look, I think that what differentiates the great founders is that when the chips are down, they come up with plan A, B, C, and D. And you need to have all these plans, because not only, even if there is money, everything's going to take longer than you expect. So even if your business is doing well, it's going to take 6 months, not 3 months or 9 months. And what has happened through other crises, Brexit was a bit of a crisis, COVID was a crisis, there's been a lot of these crises, is that there's lots of other ways that you can also think about raising cash, even if it's just to bridge the gap. And I'll give you an example. There was a company that approached us. So Market Finance, we lent over 3 billion to businesses. They're not all VC backed. Some of them are sort of owner owned, but mainly through like debt products. So we started with invoice finance, and we have other products now as well. And a company came to us last week. They struggling to get their Series A closed. It's taking longer than I expected. It's a kind of metaverse, digital business. They build metaverses for big brands online. It's a super good business, but it's tough. But then they realized that they were doing business. They were looking at venture debt, right, which is super expensive and it's very onerous and very really expensive usually. And so they came and they were like, we have all these contracts with Burberry and like big brands. Can we take those invoices and kind of turn them into cash? And obviously that's something that we're helping them with. But there's other things like asset finance. I'm sure you're going to talk about grants in a second. And there's a lot of money available for grants, right? Like, and like, some companies I see are like hiring people, and their job is to like focus on understanding what grants are out there. And I would just finally close in that the future, there's also this big trend which is called like embedded finance. So actually you can, if you're in B2B, you can start to like plug in technology. We're doing this that allows you to offer terms to your customers, pay later, and then you get the cash up front. So if you build that into your product, all of a sudden you don't need as much equity fundraising, because a lot of equity covers working capital, which is not a good use of it. So yeah, I would just encourage everyone to have the plan B and the C and the D, because you can't just hope that equity will come.
Maybe kind of as a follow-up question, I'd also love you to answer this as well, Adam. How do you see founders educating themselves about these alternatives, right? Because it's not obvious,
Yeah, it takes time. And I would always say is like, it's usually very hard for like the founder. There's so many things going on that it's very hard to do everything. But if I was to give one tip, maybe I'll give this tip, it's like to just nominate someone on the team, like who spends meaningful time, because these things can make a huge difference. Whether it's a grant, whether it's unlocking cash from invoices, whether it's asset finance, whether it's embedding stuff into your product that releases cash flow early. Like these things, it could be a product person, it could be a finance person, but having someone whose job it is in this period to focus on that, I would say is really time well spent.
So how do people find you, Adam? How do they find Claimer?
Hey, well, we've done a really crap job of marketing the sales so far, so they probably don't at the moment unless they've spoken to someone that's our customer. But we're changing that, right? We've been very product focused for the last couple of years, and you'll probably be hearing more about us in the coming year and a half or 2 years, or hopefully less than that, actually, if it works. So yeah, I mean, honestly, like London and Manchester, I mean, sort of the hubs in the country generally know about R&D already. And I think there's, I think there is this kind of big sort of misconception that people are sort of treating R&D like some extra sort of cash, right, just to survive, but really the sort of spirit of R&D and sort of the you've got kind of bigger problems if you need R&D to survive another month kind of thing. It's like what R&D really is there for is for kind of it's for innovation. I always like to say innovation is your only true moat, right? You can have like data, you can have like amazing team, blah, 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 but like it's innovation that is really going to drive your business and going to be the thing that sort of differentiates you and propels you, right? And R&D is there to allow you to invest in that, right? It's not about sort of allowing you to survive, although occasionally, when on that year that it makes the difference, fine, like bridges the gap to your VC round, you do what you can, you're a founder, you're scrappy, but generally it's there to try and sort of uplift and maintain that sort of that momentum.
And just to back up Adam here, it's actually a very meaningful amount of money in some ecosystems. So we invest in Spain as well. And like, I know companies that have gotten millions of dollars in grants in Spain. And I think that what you said is also really important is it's about thinking about the cash flow. I think before this point in time, you were just like, oh, this is the customer I care about solving for. This is the business I want to build, and I'm just going to go build it. And you just didn't really think as much about the cash flow. But it was actually Matt Robinson. I run a podcast, which is a horrible idea, but I had Matt Robinson on a few weeks ago, and he talked about this at Nested, and he's like, the shape of the cash flows of your business matter a lot. And if you don't understand them, and if you don't know, like, you still want to solve the same problem you're solving, but understand if it means you have a horrible negative cash cycle or positive and how you can change that. And at the end of the day, you have to pay your employees. And if you run out of cash, you're not going to make it. So I think this is becoming a much more important. I mean, we laugh because obviously, but like the number of companies that actually have run out of money because they ran out of cash, not actual like overall P&L is real.
And that problem becomes bigger and greater, exponentially bigger as you scale. So in the beginning, when you only got a few customers, you can kind of, I've sent an invoice, I'm waiting. But then you multiply that by 10 and you have different contracts, suddenly that becomes really tough. So, and that can kill your business. That kills most businesses.
And so, yeah, that's an interesting question. Like, what are the amounts that we're talking about? What have people gotten? Like,
I mean, honestly, for R&D and grants, there's a big difference between the two. They're managed completely differently. We're not yet doing grants. We have some contacts that can help. Actually, I think one of them is even in the room today. Jeff, where are you? Is he left? Is he actually left?
Jeff, please, Jeff.
Oh, he's gone to the loo. Okay. Oh, he's having a smoke or something. So anyway, Jeff is a legend. Anyway, the point is that they're different. And yeah, R&D, the amounts. I mean, there's no cap to R&D, right? It's really about sort of a proportion of what you're spending on genuine sort of innovative stuff. And this is why I say it underpins. Sort of it's got to be about sort of sort of your unique aspect of your product and pushing that forward. But yeah, I mean, on grants, I mean, if you're looking for grants, it's at the moment, it's very, very competitive. You're talking about, if you're doing it yourself, it's like low single-digit success rates. You really need kind of like a grant writer to help you, and then you get in the double digits, but it's still very, very competitive at the moment. But R&D, I mean, like Maria was saying, I mean, certainly globally, it's massive. In the UK, I mean, it's like, rule of thumb is like it's a third. If you're loss making, which I'm sure most of you are still, it's a third of, a rule of thumb, it's about a third of what you're spending on kind of genuine R&D, right? So that gives you a rough idea. That helps.
That makes a lot of sense. I think within this debate about, fundraising at this rocky time, there's also people who say, okay, well, there's so much, VCs have fundraised so much already. So how is it going to be difficult for founders to raise because VCs need to deploy? Is there any space for that argument to be made? Emma, maybe you have an answer for that question.
Look, we're paid to be optimistic, right? So even in doom and gloom scenarios, we've still got a job to do. And most of us do it because we're high risk takers. It's not, it's a certain personality type that's in it. But at the same time, you got to remember, it's not just funds and people with money that you're dealing with. You are dealing with individuals, and what founders go through is honestly so much harder than what we go through. But we also have to work with founders, and it's emotional for you working with a lot of founders, and especially if all of them or a significant number of them are having a hard time. And so as a founder, when you're pitching to someone, yes, you're pitched to a fund and they have a strategy, and you're pitched to an individual and they have a market interest and everything else, but they're also a person that might be having just a fucking bad day or a bad month or whatever. But we don't have any pressure from our investors right now to slow down. They're not saying like the market's bad, don't invest your capital. But there is And you know, it might seem like doom and gloom now, but honestly, just reverse back 3 years, it wasn't that different to what it is today. It's just the last 3 years was so ridiculous. And so it might seem like this huge drastic step, but I saw Aditz in the crowd, who's a founder we backed back in 2015 or 2016. It's not like, if you look at funding valuations back then, they were still lower than what we're seeing today. And time from first meeting to investment decision, I think used to be like 3 months at seed. It's still shorter than that today. And so it's really not as drastic as what it may seem in the press. And people are sitting on money, and we do love what we do genuinely. And we are genuinely looking to back like amazing people that are doing interesting things. And so, yeah, it's really not as doom and gloom as it seems.
I think there's also an argument to be made that it's actually good for founders too, right? Easy, says the VC, not raising an evaluation. I get that. But I think that it does sometimes force you to build your business differently, right? You're raising at a reasonable valuation. You don't want to take too much money. A lot of founders I know who have bootstrapped before they've raised, they feel like they didn't want to go do that experience again because bootstrapping is really painful, but they felt like it helped them find customer fit faster because like if they didn't have customer cash coming in, they weren't making any money. And so they had to really get the product that fit. And I think there is sometimes like, actually crypto is a great example. I heard a horrible stat a few months ago when it was like, before all of this went down and crypto companies were raising at 100 million and doing nothing, and somebody had hired a dev for 450,000 base. And I don't know about you guys, but I don't know anyone who should pay 450,000 base in a 5-person company. So you hear that's what happens when people raise too much money sometimes. So like, I don't think that's the norm, but it happens somewhere. So I think that there is a point to be made that it can help you build the right way.
What about on the retail side of things? You know, you said that you're still seeing demand from retail investors, but what is that looking like going forward, do you think?
Yeah, I think it's interesting. I mean, we've always relied on the institutional market as a bit of a tracker. So we tend to top up lead investment from either angels on the lower end and then VCs on the higher end. And that enables us to price, and it enables retail just to sort of follow that capital. I mean, same as you guys, right? Like, we have to be bullish. But the reality is, for us, the right valuation with the right team and the right business, it's not like there's no opportunities anymore for founders. It's like that hasn't turned off, and founders need capital. So for us, we're not really too bothered about what these guys do. And actually, for us, if they decide not to write a check, we do get those opportunities that come to us, notably What 3 Words, notably City Mapper. And that was actually off the back of Brexit, I think, or one of the other crises, and however many there were. And that was because their VCs got cold feet. And they came to us and said, we can't raise capital right now, what can you guys do? And we raised up to prospectus limit for both of those businesses from thousands and thousands of people who love the company. Without selling Crowdcube too hard, our terms are also very founder friendly. I think looking at my question to you guys is like, actually, if I'm allowed to ask a question, can I ask a question? Yeah, I mean, the depressed valuation's not enough, right? Like, you talked about potentially taking advantage of these more favorable terms. If it's going to elongate the amount of time, which is very, very tough on some of these founders to take more time to do these deals. Like, we pride ourselves in doing very fast deals, and that's what founders love. Again, not pushing it. But is the depressed valuation not enough to actually say, look, you guys can take the forward seat here and say, look, I'm going to get ahead of the rest of the VCs and mop up all this opportunity? Is it not massive opportunity right now to get in with great valuations?
Definitely. I think the only change that we've made is encouraging at least 3 years worth of runway rather than we'd usually say 18 to 24 months. And so with that naturally comes slightly more dilution. And we have not done one deal because a founder didn't want to take 3 years of runway. And that's fine. We weren't the right fit. But there is a conversation about there is a massive opportunity right now. It's really interesting because during the market over the last couple of years, you saw seed investors do pre-seed, Series A did pre-seed, Series A did seed, and now the Series A have gone back to Series A. And, the seed investors are left at seed and pre-seed are left at pre-seed. And so because they have disappeared a bit, there is more businesses that are looking to just raise from seed funds. So there are more opportunities. But I don't know how you guys are finding it. The top of funnel, I think people will have read what's going on in the markets and the press, and we're generally not seeing the top of funnel as full as what it usually is. And I think people have been put off to go out fundraising at this time.
I agree. I think that's actually more. I think the VCs, you make great returns in down markets. Some of the best VC returns are in down markets. So I think it's an opportunity for sure. But I think to your point, a lot of people, because they didn't want to have to need the money, have either cut people. Like at one of our companies, it was almost like these double waves. Like everyone kind of reacted right away. And I remember one of my companies being like, okay, we've cut as deep as we can go. And not necessarily with people, but they like saved a bunch of costs. And then like 6 months, they're like, okay, so we did that again. We got rid of our office. We did this thing. And now we have like another 12 months. And so I think people are just trying to make sure they have enough space. So I think it's great for VCs in that sense. But I think to Emma's point before, when she said it takes a long time, I think that's the growth stage rounds, right? Pre-seed rounds, we still do them on average in a week, can be 2 days, can be 24 hours. Like I've done 14 diligence calls in 24 hours when it was a competitive deal. It'll definitely happen, right? So we still do the work, but we can move really quickly. I think the late stage rounds, though, does matter. I actually think right now, if you're starting a company, it doesn't make any sense to me, but you have a really good time if you have absolutely zero fucking traction, like nothing, just person and idea, or really great traction. Where you get really screwed is you're like kind of in this middle no man's land. It shouldn't be, right? You've demonstrated that you've made some progress and whatnot, but there right now it's been harder to raise. Either like person and idea or like really good traction seems to be doing better than something in the middle. But I would say that on the late stage rounds, people really double click. My husband's the CFO for a company that just raised a 20 million round. And I remember telling him and his founder with utmost confidence in December, I was like, why are you hearing like so much about this 5-year model? Like I was like, no one's even going to dig into it. They're not going to spend time on it. And I like ate those words so many times. Like they just, I think they had to do like 45 versions of it for one investor. So like that, if you're doing a growth stage round, they will double click. It will take a long time. But growth stage rounds were getting done in a week last year, which is not the case now. But it's almost like righted it.
I would just add that we almost haven't, I mean, there's a bit doom and gloom, but we haven't seen the worst of it, I think, because everyone who could avoid fundraising Series A, B, haven't done it this year, but they're going to probably have to do it next year. And so next year might feel even tighter. So I would just, I guess it might get worse before it gets better. And then I would also say, like, what we've seen a little bit more of is more creative thinking is around, like, approaching, I don't know, your biggest customer and asking them to sort of participate in some sort of strategic round, or taking like some sort of safe or a note from someone that you work with, a supplier, or that again, just to come back to different plans. That's the most I would encourage people to do, is to think that through.
Amazing. Well, I think if we can let a panelist ask a question, we can also let the audience ask questions, because we're coming up on about 30 minutes. Who would like to ask something? Cool. Let's have the front row here. I can run the.
There you go.
I guess just a general, more market type question on the kind of VC side. If you've got all the late stage parties, funds moving back, kind of going from Series A, when they were Series A doing C, going up back to Series A, why? Oh God, my brain's just died now. No, hang on. So before Series A funds were coming earlier, Series B funds were coming earlier, seed were going earlier. Now when the later stage is getting harder, when exits into IPO and acquisitions are getting harder, why do you think that they are going back up when actually, if you were to invest in seed rather than Series A, you instinctively give yourself an extra year or year and a half of leeway before that company would exit? So Claimer would have an extra, if you were to invest in Claimer at seed, you probably would have an extra year and a half than if you invested in the Series A. So you would think people should move earlier in a way if they have the funds. Is that?
So we call it the beach. So the beach is lovely. Everyone fucking loves the beach. And you go on your summer holidays, it's great. But it gets really rough there in winter. And most people go back, and they go back up to the hills where it's like a bit nicer and sunnier. But it's really rough. And only some people like staying there during the rough times. And that's how we try to paint a pity picture of a dark situation. And it happens in waves. So our two co-founders at Local Globe, Robin and Saul, Robin got taken into Index Ventures like years ago to set up their seed fund, the first time they wanted to invest at seed. And he did that for years, and it was brilliant. And then it was a down market again, and Index pulled back from seed, and that was when he rolled out, because he still wanted to do seed and institutionalize what Local Globe was. And you just, in waves where it's like a hot market and everything's so competitive, people just naturally come earlier because you have to get into the best deals. And I think that the exception is if you're a proven second-time founder, you'll still get investment straight off of an idea. You don't even need a pitch deck if you're a proven founder. But other than like, if you're a first-time founder and you're not yet proven, it is just higher risk, and people just
If I
pull back.
founded an ice cream hut, does that count?
I think it's also you can afford to wait, right? Yeah, I think there was also the hat in the back, but you can also afford to wait, right? So like if you're a Series A investor, as Emma said, and it's competitive, you have to get in that deal before you can see the traction, but now you can kind of wait and see the traction before you decide to invest if you're typically Series A.
To that point, you mentioned before that you thought that it was easier to raise person with idea. If we cut out the first-time founder, second-time founder element, why do you think now it's easier to raise a person plus idea than idea with a bit of traction? And is that a new thing, or is that just is that something that's always sort of been there?
It's a good question. I don't know if it's probably always been a little bit of a thing. It feels exacerbated right now. And I think it's probably because of how it's institutionally set up. So like we're pre-seed and seed investors, so we're usually investing a person and an idea, can be traction as well. But a lot of Series A funds would want to see something before they would actually invest. I think there's probably, in a down market, you probably are trying to see, my only theory is that you feel like it's not taking off, right? But I also have a lot of counterexamples where I personally invested in something with a little bit of traction. So I don't have a lot of logic to it. It's just what I've been seeing across the board with all of our companies raising. It seems counterintuitive to me. That's why I noticed it, because I'm like, it seems like it shouldn't be easier with just an idea. But I think that the reality is it's probably your second round. Your first round is probably fine either way, but your second round, people are kind of waiting to see the traction.
Anyone else?
The guy with the hat asked a while ago too, if you want to, I don't know if you want to.
Cheers, thanks.
Thanks, guys.
So this might be a more American skewed view, but from the sounds of it, there's like more dry powder than ever. It's like almost 300 billion of dry powder out there that's sort of been slowed during this year. That, we all know what the VC's business model is. You've got to deploy capital for your LPs. So surely there will be some level of correction if the last couple of years have seen a little bit of a pullback in the coming years where people feel the need to deploy more.
Yeah, I mean, I thought that we wouldn't see as much recession in the VC markets because of that, because there's so much dry powder. But it also depends. Like, there was a lot of dry powder that probably did actually just evaporate as well. Like, a lot of people came into late stage that got their, quite frankly, butt handed to them last year. And so they decided not to do that anymore and to go back to public markets. So I think some of it evaporated, but there's still a lot of it there. So I think if you're a good company, you'll still get funded, and it's not going to really go away in a real sense. I don't know if you...
Yeah, just one more thing to add. I kind of alluded to it earlier. Like, I'm not speaking for all institutional investors, but for us, definitely, we don't have any pressure to deploy our funds at any type of speed. We take money from people that are like really long-term investors. They know venture well. They're not expecting returns like anytime in the near future. So we have no pressure to deploy the capital to get returns quicker. So therefore, speed it's more on us wanting to spend money than it comes from pressure from our investors. But, there is a lot of dry powder out there. And like, we all love our jobs. Like, we're going to be hunting to make deals. And, we're all, well, especially Maria and I, because we're such early stage investors, like, we're invested in business models that we believe are going to be really big in 10 years, if not 15 years time. And so like worrying what the market fluctuations over the next couple of years, like, yes, you have to take a product to market and you need to sell it, but we're not worried if you're not going to hit the inflection points that we believe you will be able to hit in like real distant future.
Okay, well, I'm conscious that there are drinks and a little bit of food waiting. So I'd love to just close off with one tip that everyone can take away from this about fundraising. Start with you, Johnny.
Cool. I would say try as much as possible to ignore a lot of the noise right now. I think you can get caught up in it a bit too much, and to be bold, be confident, still believe in what you're doing. Listen to the pros who can give you guidance on valuation and all that good stuff and not screw you on really difficult terms. But believe in yourself. Like, the opportunities are still there, and go at it as aggressively as you would have last year.
You stole my tip.
Was that it?
It was basically turn your critical thinking up to 11, right? Like, there's so much.
That's way better.
The soundbite. No, there's so much there's so much negativity out there. It's like, look at your business, and everyone's talking about cut costs. But like, if your business, if you can see there's like, don't cut costs if there's a route to something. Like if there's like, you can invest a little bit. Like it's not the kind of like, you can, I mean, obviously sales people are, in great demand right now for a good reason, because there's all these founders that are sort of seeing an opportunity, and some of the biggest companies that we know, kind of started in periods like this. It's like anything, like the stock market or anything. When everyone's running one way, you have to really critically think, like, do I want to run the same way, or do I have an opportunity to do something unique here? So I just say critical thinking up to 11.
I would say be realistic. So, like, I know I always like to tell the story that we started 10 years ago, like pre-WeWork, like there was no such thing as WeWork, and we raised 300K on an 800K valuation. My brother started a company last summer and raised 5 million on a 25 million pound valuation, right? And you just had some PowerPoint slides. That time will probably never come back, or it won't come back for a very, very long time. So, I would say be realistic, be real. Don't get caught up in the vanity of like the VC like valuation. At the end of the day, it's delighting customers, making profit, being like a good business, and stay focused on that. And I'm just going to second tiny one. Shout out to R&D tax credits. I was sitting with my finance team, and I was like, shit, like the burn is going crazy. What's going on? And I was like, what's happening in December? Because the burn is not so bad in December. And they were like, that's the month the R&D tax credit comes in. And I was like, that's amazing. Can we do more like that?
Maria kind of alluded to it earlier, but like blind reference in your VCs for sure, but not like the companies that are doing well because everyone wants to be their best friends. Like try and find companies that that investment partner has invested in that have gone like badly, and reference those founders, because that's when you really find out what people on your cap table are like. And then the other thing that's I think is less discussed is if you bring multiple investors in a funding round, especially if they're sort of joint ownership in the round, make sure that they are aligned on what they think is most important for your business over the next 12 months. Because the amount of times, especially at pre-seed seed stage, we have one investor on a cap table that's like, you really need to focus on product and finding customers and, really obsess over the product. And another side of the table can be like, you need to sell, you need to make revenue, like blah, blah, blah. It's horrendous experience for founders, like really horrendous, because you've obviously built like a trust and a bond with these two different sides, and they've experienced their own either businesses or founders that work with, and they've seen successes and failures in different ways, and just checking that they're aligned, and so the three of you can work in like a really, well, it's never going to be completely harmless, but as harmless as possible is like really important.
I was going to go with that first sentiment of just the best fundraising advice is build a good business. So just do that. But I'll change it since you guys already, but just don't do it alone, meaning not with your team. If you don't already have founders you can call, because the best way to know what's normal in market and what's going on is to have founders that you can pick up the phone and say, is this normal, or what do you think of this? So if you don't already have a founder network, you're literally surrounded by founders. Don't leave tonight without 2 new names of people that you can call and you can ask advice to. And also obviously disclaimer.
Love it. Thank you so much, guys, for all of your insights.
Thank you.
Thanks so much, guys.